Today, we're diving into the exciting world of leveraged investing. Leveraged investing is a powerful tool that can help you achieve your financial goals faster than traditional investing methods. It's a strategy that can potentially supercharge your returns. By using leverage, you can amplify the impact of your investments, making your money work harder for you. But before you get too excited, remember that leverage is a double-edged sword. While it can enhance your gains, it can also increase your losses if the market moves against you. It can magnify your gains, but it can also amplify your losses. This is why it's crucial to have a solid understanding of how leverage works, and to use it responsibly. Leverage basically means using borrowed money to invest. This borrowed capital can come from various sources such as margin accounts or loans. You're essentially putting more money to work in the market than you have in your pocket. This allows you to take larger positions and potentially earn higher returns. This can be done through margin accounts or by taking out loans. Margin accounts allow you to borrow money from your broker to buy securities, while loans can provide the capital needed for larger investments. Think of it like this. You want to buy a house. Instead of waiting years to save up enough money to pay in cash, you can take out a mortgage and buy the house now. You could save up for years to pay in cash. This approach requires patience and discipline, but it also means you miss out on the benefits of homeownership during that time. Or, you could get a mortgage and buy the house now. The mortgage is leverage. By borrowing money, you can own the house sooner and start building equity right away. You're using borrowed money to control a larger asset. This same concept applies to investing, where leverage allows you to control a larger portfolio. The same principle applies to investing. By using leverage, you can diversify your portfolio and potentially increase your returns. With leverage, you can control a larger portfolio of stocks, bonds, or other assets. This can help you achieve your financial goals more quickly. This can potentially lead to bigger returns. However, it's important to remember that leverage also comes with increased risk. But it's crucial to understand the risks before you jump in. Make sure you have a clear strategy and risk management plan in place to protect your investments. Let's crunch some numbers. Over the past 2 decades, the financial landscape has transformed dramatically. From the dot-com bubble to the rise of tech giants, the market has seen it all. Imagine you commit to investing $13,500 every month for the next 20 years. This disciplined approach can set the stage for substantial financial growth. You've got a solid plan. 35% VGT, Vanguard Information Technology ETF. This ETF is designed to track the performance of the tech sector, which has been a powerhouse of innovation and growth. This ETF tracks the tech sector, an area ripe for growth. Companies like Apple, Microsoft, and Google have driven incredible advancements, making tech a lucrative investment. 35% VG, Vanguard Growth ETF. This ETF focuses on high-growth companies across various sectors, providing a diversified approach to capturing market gains. This ETF focuses on high-growth companies across various sectors. From healthcare to consumer goods, these companies are at the forefront of their industries, driving innovation and expansion. And 30% VOO, Vanguard S&P 500 ETF. This ETF provides broad exposure to the entire S&P 500 index, which includes some of the largest and most stable companies in the U.S. This ETF provides broad exposure to the entire S&P 500 index. Investing in the S&P 500 means you're betting on the overall growth of the U.S. economy, which has historically been a reliable strategy. Assuming a hypothetical average annual return of 7%, your portfolio could grow significantly over 2 decades. This kind of growth can turn your consistent investments into a substantial nest egg. After 20 years of disciplined investing, your total investment would be a whopping $3,240,000. This figure represents the power of regular, committed investing. And with that 7% average return, your portfolio could balloon to an impressive $7,850,000. This is the magic of compound interest working in your favor. That's the power of consistent investing and compound growth. By reinvesting your returns, you allow your money to grow exponentially over time. But what if we could kick it up a notch? What if there was a way to amplify these returns even further? That's where leverage comes in. By using borrowed capital, you can potentially increase your investment returns, though it comes with its own set of risks and considerations. Now let's get really ambitious. What if, instead of $13,500, you invested $27,000 per month? That's right, we're talking about doubling down with leverage. You'd still maintain the same investment split, 35% VGT, 35% VG, and 30% VOO. But now, you're borrowing an additional $13,500 each month to fuel your investments. With this leveraged approach, your total investment over 20 years would skyrocket to $6,480,000. And assuming that same 7% average annual return, your portfolio could reach a staggering $15,700,000. That's the allure of leverage. It has the potential to significantly amplify your returns. But remember, we haven't factored in the cost of borrowing yet. Leverage isn't free. When you borrow money, you're on the hook for interest payments. Let's say you secure a loan at a 5% annual percentage rate, or APR, to fund the additional $13,500 monthly investment. Over 20 years, the total interest paid on that loan would amount to a hefty $4,620,000. That's a significant chunk of change. It's crucial to factor in the cost of borrowing when evaluating the potential returns of leveraged investing. Remember, leverage magnifies both gains and losses. If your investments don't perform as well as expected, those interest payments can eat into your returns. Section 5. Net Worth Showdown, Leverage versus No Leverage. This section will delve into the financial outcomes of two distinct investment strategies over a span of 20 years. We'll explore the impact of using leverage versus not using leverage, and how each approach affects overall net worth. Let's compare the two scenarios after 20 years. Scenario 1, no leverage. In this scenario, the investor relies solely on their own capital without borrowing any additional funds. Total investment, $3,240,000. This amount represents the sum of all investments made over the 20-year period. Estimated portfolio value, $7,850,000. This value is based on the growth of the investments over the 2 decades. Net worth, $7,850,000. Now let's move on to Scenario 2, leverage. Here the investor uses borrowed funds to amplify their investment potential. Total investment, $6,480,000. This includes both the investor's own capital and the borrowed funds. Estimated portfolio value, $15,700,000. The use of leverage has significantly increased the portfolio's value. Loan repayment, $3,240,000 principal, plus $4,620,000 interest, which totals $7,860,000. This repayment includes both the principal amount borrowed and the interest accrued over the 20 years. Net worth, $15,700,000 minus $7,860,000 equals $7,840,000. After accounting for the loan repayment, the net worth is calculated. In this hypothetical scenario, the net worth difference between the two approaches is, well, negligible. Despite the higher portfolio value in the leverage scenario, the substantial interest payments reduce the net worth to a level similar to the no leverage scenario. The amplified returns from leverage are essentially offset by the substantial interest payments. This highlights the importance of carefully considering the costs and benefits of using leverage in investment strategies. Section 6. The Leverage Dilemma, Weighing the Risks and Rewards. As you can see, leveraging investments is a complex decision. It's not a one-size-fits-all strategy. There are both potential benefits and significant risks to consider. Benefits of leverage amplified returns. Leverage can potentially supercharge your investment returns, helping you build wealth faster. Increased buying power. Borrowing allows you to invest more money than you currently have available, potentially capitalizing on market opportunities. Risks of leverage. Magnified losses. Leverage amplifies losses just as it does gains. If your investments decline in value, your losses will be greater with leverage. Interest payments. Borrowing money comes at a cost. Interest payments can eat into your returns, especially if your investments don't perform as expected. Margin calls. If your leveraged investments experience significant losses, you may face margin calls requiring you to deposit additional funds or sell assets at a loss. Section 7. Should you take the plunge? Critical questions to ask. Before you even think about leveraging your investments, ask yourself these crucial questions. Risk tolerance. Can you stomach the potential for amplified losses? Leverage is not for the faint of heart. Financial situation. Are you in a solid financial position to handle potential losses and interest payments? Investment horizon. Do you have a long-term investment horizon to ride out market fluctuations? Interest rates. Are interest rates favorable? High interest rates can significantly diminish the benefits of leverage. Section 8. The Kramer Verdict, a word of caution and encouragement. Remember, investing always involves risk. Leveraging your investments adds another layer of complexity and risk. It's not a strategy I recommend for everyone. However, for investors with a high risk tolerance, a solid financial foundation, and a long-term perspective, leverage can be a powerful tool. But proceed with caution, folks. Do your homework, understand the risks, and never invest more than you can afford to lose. Section 9. Disclaimer: proceed with prudence. The information provided in this essay is for educational purposes only and should not be considered investment advice. Always consult with a qualified financial advisor before making any investment decisions. Remember, investing involves risk, and past performance is not indicative of future results.